Welcome students, Tom Harmer here, your professor, and this is a Chapter 12 demonstration of accounting for the purchase of a debt investment, and then the servicing of the interest payments on that debt investment, then the sale of a portion of the debt investment and an accounting for the receipt of interest from that investment after that partial sale, and then also the financial statement presentation for the debt investment. So here we go.
Connors Care Centers provides financing and capital to the healthcare industry with a particular focus on nursing homes for the elderly. The following selected transactions relate to bonds acquired as an investment by Connors, whose fiscal year ends on December 31st. We need to journalize the listed transactions for the years 2011 and 2014. Assume that the fair value of the bonds at December 31st, 2011 was $1,100,000. We need to prepare the adjusting entry to record these bonds at fair value. And then we want to prepare balance sheet presentations of the bonds and interest receivable as of the end of the year. On January 1st, purchase at face value, $1 million of Carmen Nursing Centers, Inc., 10-year, 8% bonds, dated January 1st, 2011, directly from Carmen. So we increase the asset account debt investments by a debit of $1 million and credit cash for $1 million. On July 1st, receive the semi-annual interest on the Carmen bonds. We take the $1 million as the face value of the bonds times the 8% times 1/2 year. We debit cash for $40,000 and credit interest revenue for $40,000. On December 31st, we have the accrual of interest at year-end on the Carmen bonds. We debit interest receivable for $40,000 and we credit interest revenue for $40,000. Assume that all intervening transactions and adjustments have been properly recorded and that the number of bonds owned has not changed from December 31st, 2011 to December 31st, 2013. On January 1st, 2014, received the semi-annual interest on the Carmen bonds. So we debit cash for $40,000 and credit interest receivable for $40,000. On January 1st, sold $500,000 Carmen bonds at 106. The broker deducted $6,000 for commissions and fees on the sale. We credit debt investments for $500,000. We debit cash for $500,000 times 1.06 minus $6,000, $524,000, and we credit gain on sale of debt investments for $24,000. On July 1st, received the semi-annual interest on the Carmen bonds. We debit cash for $40,000 and credit interest revenue for $40,000. On December 31st, accrual of interest at year-end on the Carmen bonds. We debit interest receivable for $40,000 and credit interest revenue for $40,000. In Part B, assume the fair value of the bonds at December 31st, 2011 was $1,100,000. These bonds are classified as available for sale securities. Prepare the adjusting entry to record these bonds at fair value. So the difference between $1,100,000 and $1 million is $100,000. We debit market adjustment, available for sale securities, and credit unrealized gain or loss equity for $100,000. Based on your analysis in Part B, show the balance sheet presentation of the bonds and interest receivable at December 31st, 2011. Assume the investments are considered long-term. Indicate where any unrealized gain or loss is reported in the financial statements. In the current assets section of the balance sheet, we have interest receivable of $40,000. And the investment section of the balance sheet, we have debt investments at fair value, $1,100,000. Now, the unrealized gain of $100,000 would be reported in the stockholders' equity section of the balance sheet as an addition to paid-in capital and retained earnings.
Okay, there you go. There's a good demonstration of the problem P12-1A.